Breaking alert. Silver price is about to do what? Silver just crossed $80 an ounce. Gold is sitting above $5,000. And the people who quietly move markets are doing something they haven't done in years. This is not a rally. This is not a spike. This is a signal. And once you understand what is actually behind this move, you will never look at your savings, your business, or your future the same way again. But here is the part no one is talking about. The biggest move hasn't even started yet. Welcome to Metal and Macro, where we cut through the noise and give you the analysis that actually matters. Now, if you have found this channel for the first time, think of subscribing like putting on your reading glasses before the newspaper arrives. You could try to read without them, but why would you miss a single word? Hit that subscribe button so not one briefing passes you by. And before we go any further, drop a comment below and tell us what city, what country, what corner of this world are you watching from today? Because this story touches every one of them. There is a moment in every market cycle when something shifts beneath the surface. Not loudly, not dramatically, but quietly, deliberately, and with a precision that most people simply are not trained to see. That moment, according to every reliable economic indicator available today, appears to be happening right now. And at the center of it all sits one metal, silver. On the surface, the story looks simple. Silver pushed back above $80 an ounce. Gold climbed back above $5,000. Numbers that would have seemed impossible to most investors just a few years ago are now sitting on live price screens as ordinary facts. The financial media picked it up. Social platforms ran with it. And across trading desks, kitchen tables, and business forums around the world, the same question began circulating with increasing urgency. Is this the beginning of something enormous? Or is it just another loud move that burns bright and disappears just as fast? That question deserves a serious answer, not a headline, not a prediction wrapped in excitement. A real, structured, analytical answer. And that is exactly what this briefing sets out to deliver. To understand what silver is doing right now, one must first understand what silver actually is. Most people look at it and see a price, a number on a screen, something that goes up when people are nervous and comes back down when things calm. But that framing is dangerously incomplete. Silver is not simply a commodity that responds to emotion. It is a dual-purpose asset, unlike almost anything else in the global financial system. It functions simultaneously as a monetary metal and as an industrial raw material. That combination gives it a sensitivity to economic conditions that gold, for all its prestige, simply does not possess in the same way. When industrial demand is strong, silver feels it. When currency systems come under pressure, silver feels that too. And when both forces align at the same time, silver does not just move. It moves with a kind of velocity that catches even experienced market observers off guard. The current environment carries the fingerprints of exactly that kind of alignment. And that is what makes this moment worth examining with serious attention. Now here is where the analysis must be precise. When silver crosses a round number like $80, the instinct for most observers is to treat the number itself as the story. 80 feels significant. It sounds significant. And in a purely psychological sense, it is. Round numbers act as gathering points for human attention. They create the feeling that a door has opened, that permission has been granted to believe in further movement. But the round number is not the story. It never is. The real story lives one layer deeper. It asks a different set of questions entirely. Who pushed the price through that level? Was it retail investors reacting to headlines, or was it patient strategic capital that had been building a position for months? Was it a short squeeze that forced reluctant sellers to cover? Or was it genuine buying conviction from institutions that see something in the macroeconomic landscape that the broader public has not yet processed? Those questions are not easy to answer from a single day's price action. But they are the only questions that actually matter for anyone trying to make intelligent decisions with real money and real business strategy. What the most recently available market data suggests is this: the move in silver going into this particular weekend was not a slow, grinding drift higher. It was sharp. It had energy behind it. And silver, notably, outpaced gold in terms of percentage movement. That detail is not decorative. It is a clue. When silver moves faster than gold, it typically means one of two things. Either industrial demand is accelerating, or speculative positioning is heating up at a pace that the fundamentals may not yet fully support. Distinguishing between those two possibilities is the difference between a strategic opportunity and an expensive mistake. And that distinction leads directly into the next layer of this analysis, because sitting quietly in the background of all this price action is a ratio, a single number, one that millions of investors check daily and almost all of them misread. The gold to silver ratio and the trap hidden inside it. That comes next. There is an old saying among the people who have studied money for a living. They say that the most dangerous number in any market is the one that feels like it is telling you everything, when in reality, it is only showing you half the picture. In the world of precious metals, that number has a name. It is called the gold to silver ratio. And right now, that ratio is sitting at a level that has the financial world buzzing with confidence. Perhaps too much confidence. Here's how it works. Take the current price of gold, divide it by the current price of silver. The number you get tells you how many ounces of silver it would take to buy a single ounce of gold. Simple arithmetic, clean and easy. And that simplicity is precisely what makes it so seductive. Because when a number is easy to calculate, people tend to assume it is also easy to interpret. And that assumption, historically, has cost investors dearly. As silver climbed back above $80 and gold held firm above $5,000, the gold to silver ratio slid down into the low 60s. In the language of metals analysis, that is described as ratio compression. Silver is gaining ground relative to gold. And across financial forums, investment newsletters, and weekend market briefings, the conclusion being drawn from this compression is almost universally the same. Silver is cheap, silver is catching up, silver is the trade. But pause there, because that conclusion skips several steps that serious decision makers cannot afford to skip. Consider what this ratio has looked like across history. During the financial crisis of 2008, the ratio exploded above 80, meaning silver became extraordinarily cheap relative to gold. What followed was not an immediate silver rally. What followed first was a brutal sell-off that took silver down sharply before the eventual recovery. During the market chaos of early 2020, the ratio surged above 120. Silver looked historically cheap by every conventional measure. And yet, in the weeks that followed, silver dropped hard before finding its footing and eventually staging one of its most aggressive recoveries in modern memory. The pattern here is not that the ratio was wrong. The pattern is that the ratio told part of the truth while quietly concealing the rest. Think of it this way. A thermometer on the wall can tell a person that the room is cold. It measures the temperature accurately and without bias. But the thermometer cannot tell that person why the room is cold. It cannot tell them whether the heating system failed, whether a window was left open, or whether a storm outside is dropping temperatures so fast that no heating system on Earth could keep up. The diagnosis requires more than the reading. And in markets, the diagnosis always requires more than the ratio. So what is the ratio actually revealing right now? At its most basic level, the compression into the low 60s is telling the world that silver is gaining momentum relative to gold. That is real. That is measurable. But here's the layer underneath that most observers are not discussing with sufficient seriousness. Ratio compression of this kind can emerge from two very different engines. The first engine is genuine fundamental strength in silver, industrial demand accelerating, supply tightening, smart institutional money rotating into silver because the underlying case for the metal is strengthening. That version of ratio compression is the one bulls are currently celebrating, and it may well be the correct interpretation. But the second engine is where the trap lives. The second engine is speculative heat, retail momentum, the kind of enthusiasm that builds when a number breaks through a psychological threshold, and suddenly everyone who had been sitting on the sidelines decides simultaneously that they cannot afford to miss what comes next. When that engine is driving ratio compression, the move can be dramatic, convincing, and fast. It can feel exactly like the first engine. Until it doesn't. And when speculative heat breaks, it does not break gradually. It breaks suddenly, without warning, and it takes the ratio with it in the opposite direction faster than most investors can react. This is the trap. And right now, the evidence for which engine is actually running beneath this silver move is not yet conclusive. What is conclusive is this. The ratio alone cannot answer the question. Something else must be examined. Something bigger. Something that connects silver not just to gold, but to the entire architecture of the global economy. There is a particular kind of intelligence that separates the serious investor from the casual observer. It is not the ability to read a chart faster. It is not the confidence to make bold predictions on a Friday afternoon. It is something quieter and considerably more powerful. It is the ability to zoom out far enough to see the structure behind the movement, to look past the price and ask the question that almost nobody in a crowded market is willing to slow down long enough to ask. Why is this happening right now, in this moment, in this particular configuration of the global economy? That question, applied honestly to silver's current behavior, leads somewhere most weekend market commentary simply does not go. It leads into the macro architecture. The deep, slow-moving forces that do not show up in a single day as price action, but that ultimately determine where every major asset goes over the months and years that follow. And when those forces are examined carefully and without bias, what they reveal about silver's current position is not comfortable. It is not simple. But it is extraordinarily important for anyone making serious financial and business decisions in today's environment. Begin with the most fundamental fact about silver that the majority of its own investors tend to underweight. Silver is not gold, that sounds obvious, but the implications run deeper than most people appreciate. Gold is almost purely monetary. The world holds gold because it has held gold for thousands of years. Central banks accumulate it, governments store it, wealthy families preserve it across generations. Its price is driven overwhelmingly by sentiment, by fear, by currency confidence, and by the collective human instinct to reach for something ancient and tangible when the modern financial system begins to feel unreliable. Silver shares some of that monetary identity, but silver also works for a living. Approximately 50 to 60% of all silver consumed globally every single year disappears into industrial applications. Electronics, solar panels, electric vehicle components, medical equipment, semiconductors. The global energy transition, which is not a political talking point but a measurable, capital-intensive industrial reality, requires silver in quantities that the mining industry is increasingly struggling to match. Every solar panel installed anywhere on Earth contains silver. Every electric vehicle rolling off a production line contains silver. And as the world's largest economies pour trillions of dollars into infrastructure modernization and clean energy deployment, the industrial appetite for this metal is not shrinking. It is expanding, quietly, structurally, and with a consistency that does not care what the gold to silver ratio is doing on any given Saturday. This is the first pillar of the macro architecture. Industrial demand is not a trend. It is a structural shift. And structural shifts in commodity demand do not reverse quickly. They build over years. They create supply pressure that mines cannot immediately resolve, and they eventually push prices to levels that feel shocking until, in retrospect, they feel inevitable. The second pillar sits on the monetary side of silver's identity. And here the story connects to something that every business owner, every entrepreneur, and every serious wealth builder needs to understand with clarity. The world's major currencies are under a pressure that is not new but is intensifying. Government debt levels across the United States, Europe, Japan, and beyond have reached territory that previous generations of economists would have considered catastrophic. The response from central banks over the past decade and a half has been to create money at a pace and scale that has no meaningful historical precedent. And while the immediate consumer price inflation that followed may have moderated in some regions, the deeper consequence of that money creation has not gone away. It has simply moved. It has settled into asset prices, into real estate, into equities, and increasingly into hard assets like gold and silver that cannot be printed, cannot be digitally conjured, and cannot be devalued by a committee decision made in a government building. When institutional investors, sovereign wealth funds, and the quiet, patient capital that does not announce itself on social media begins rotating into silver, it is rarely because of a chart pattern. It is because someone in a very serious room looked at the macro architecture, ran the numbers honestly, and concluded that holding paper promises backed by indebted governments carries a risk that silver, for all its volatility, simply does not carry in the same way. The third pillar is perhaps the most overlooked and the most immediately relevant: supply. The silver mining industry is not a growth industry. Discovery of new major silver deposits has been declining for years. The ore grades being extracted from existing mines are falling, meaning more rock must be processed to produce the same amount of metal. Capital investment in new mining projects collapsed during the years when silver prices were suppressed, and that underinvestment does not correct itself overnight. New mines take years, sometimes decades, to move from discovery to production, which means that even if demand were to plateau tomorrow, the supply side of this equation is structurally constrained in a way that the price does not yet fully reflect. Demand rising, supply constrained, currency systems under structural pressure, industrial consumption accelerating. These are not talking points. They are the load-bearing walls of the macro architecture surrounding silver right now, and when all of them lean in the same direction simultaneously, the resulting pressure on price is not a matter of if. It becomes a matter of when and of how fast. But knowing the architecture exists is only half of what serious decision makers need. The other half is knowing what to do with that knowledge, how to position, how to think about risk, how to avoid the traps that have consumed so many investors who understood the story correctly but still managed to lose money because they entered without a framework. There's a moment in every economic briefing where the analysis must stop being descriptive and start being useful, where the charts, the ratios, the macro forces, and the historical patterns must all converge into something that a serious person can actually act on. Not emotionally, not impulsively, but with the kind of cold, structured discipline that separates the people who build lasting wealth from the people who simply watch opportunities pass by while waiting for certainty that never arrives. That moment is now, and what follows is not a prediction. Predictions are for entertainment. What follows is a framework, a way of thinking about silver's current position that does not require anyone to be right about the future, but instead prepares them intelligently for the range of futures that the evidence currently makes plausible. The framework begins with a simple but ruthlessly honest exercise, identifying the 3 scenarios that the current data supports. Not the one scenario that feels most exciting, not the one that confirms what someone already believes. All 3. Because the market does not care about anyone's preferred narrative. It moves according to forces, and those forces can resolve in more than one direction. The first scenario is continuation. Silver holds above $80, builds a base at this new level, and begins a methodical climb driven by the structural forces, already examined in this briefing. Industrial demand continues to absorb supply. Institutional capital continues to rotate into hard assets as currency confidence erodes further. The gold-to-silver ratio compresses toward the 50s, a level that historically has marked periods of genuine silver outperformance. In this scenario, the current move is not a spike. It is the early chapter of a much longer story. And the investors who positioned thoughtfully at current levels with appropriate sizing and clear exit logic stand to benefit significantly over the months and years ahead. The second scenario is consolidation. Silver pulls back from $80, not because the macro case has broken down, but because the speculative energy that contributed to the recent push needs to be absorbed. Prices correct into the $65 to $70 range. Weaker hands exit. The narrative briefly turns negative. Financial media, which celebrated the move above 80 with enthusiasm, begins questioning whether the rally was real. And in that uncomfortable, doubt-filled consolidation period, the structural buyers who understand what they are looking at quietly accumulate at better prices, setting the stage for the next leg higher. This scenario is not a failure of the thesis. It is the thesis working exactly as history suggests it should. The question is whether an investor has the framework and the temperament to recognize a consolidation for what it is, rather than panicking alongside the crowd. The third scenario is the one that requires the most honest attention precisely because it is the most uncomfortable to consider. Sharp reversal. A macro shock arrives without warning, a sudden shift in Federal Reserve policy, an unexpected resolution to a major geopolitical conflict that had been supporting safe haven demand, a liquidity crisis in equity markets that forces institutional investors to sell winning positions, including metals, in order to cover losses elsewhere. In this scenario, silver does not consolidate gently. It drops fast, hard, and in a way that feels in the moment like the entire thesis has collapsed. This scenario has happened before. It happened in 2008. It happened in 2020. And the investors who survived those moments without permanent damage to their capital were not the ones who predicted the reversal. They were the ones who had decided in advance exactly how much loss they were willing to absorb before reducing exposure. They had a number, a line, a rule that existed before the emotion arrived. And when the emotion arrived, the rule protected them. This is the most important practical principle that this entire briefing has been building toward. Position sizing is not a technical detail. It is the single most powerful risk management tool available to any investor at any level of sophistication. The person who is right about silver's long-term direction, but wrong about timing and overexposed, will suffer real damage. The person who is right about the direction, appropriately sized and mentally prepared for volatility, will not only survive the inevitable turbulence, but will likely use it to strengthen their position. Beyond position sizing, serious players in this environment need to be watching a specific set of indicators that the broader market tends to ignore until they are already moving. The first is the behavior of mining equities. Silver mining stocks tend to lead the metal itself during genuine bull phases. When miners begin outperforming silver on a sustained basis, it signals that sophisticated capital is rotating into leverage on the silver price. That rotation has historically preceded some of the most powerful moves in the metal. The second indicator is the COMEX commitment of traders report. This document, published weekly, reveals how commercial hedgers and large speculators are positioned in silver futures. When commercial hedgers, who are typically on the right side of major turns, begin reducing their short positions significantly, it is one of the most reliable early warning signals that a sustained move higher is developing with genuine institutional support behind it. The third thing that serious players are watching right now is something that connects silver directly to the entrepreneurial and business audience that this briefing is designed to serve. It is the velocity of the energy transition. Every gigawatt of solar capacity installed globally requires silver. Every electric vehicle produced requires silver. And the pace of that installation, driven by government mandates, corporate sustainability commitments, and pure economic logic as renewable energy costs continue to fall, is not slowing. It is accelerating. Which means the industrial floor beneath silver's price is not a fixed number. It is a rising one. And a rising floor changes the risk calculation for every serious investor in a way that is not yet widely understood. The final piece of the decision framework is the most personal and perhaps the most important. It is the question of what silver actually represents in the context of a serious person's broader financial architecture. For the entrepreneur building a business, silver is not a replacement for operational capital or business investment. It is a hedge, a store of value that sits outside the system that the business operates within. For the young professional accumulating wealth in the early stages of a career, silver represents an accessible, tangible asset that carries no counterparty risk. It cannot go bankrupt. It cannot be diluted. It cannot be frozen by a financial institution facing its own crisis. And for the serious investor managing a diversified portfolio, silver at current levels, with the macro architecture aligned as it currently is, represents one of the more asymmetric opportunities available in a world where most conventional assets are priced for perfection in an environment that is anything but perfect. The signal has been identified, the ratio has been examined, the macro architecture has been mapped. The decision framework has been laid out with honesty and without hype. What comes next is the most important part of any serious economic briefing: the synthesis. The moment where everything examined across this entire analysis is brought together into a single, clear, strategic conclusion.